Stephen, great to have you on the show today. And I do want to start with net interest income. You had a big beat on that, and then you raised the forecast for that for the year. So walk me through how you're navigating this interest rate environment and what it means for the economy, since you do sort of sit at that intersection between Wall Street and Main Street.
We do. We're very much a Main Street bank, and so very, very relationship-oriented. Our net interest income is expanding simply because the Fed's raising interest rates, and we're asset sensitive. So our loan portfolio yields are increasing. We're managing very well. We're getting good loan growth, just about 10% for the year, annualized, and it's all sort of coming together after a combination with a company called TCF about a year and a half ago.
So the fact that you're still seeing good loan growth, even though we are in this rising rate environment, what would you attribute that to?
Well, we have a very strong equipment finance group. The commercial bank's doing very well. That group in particular has gone from number 7 nationally to number 5. We do a lot of asset-based lending. So in this type of a moment where general unsecured lending can be a little bit constrained as companies try to lever up and use their balance sheet, we've got a great team that does that. We're one of the top 10 asset-based lenders in the country. So our niche businesses are performing very well. And then we're in new markets, and we have scale in certain other markets. We're new to Minnesota and Colorado. We now have scale in Chicago, a great market for us. And we're a factor in Michigan, in addition to the core franchise, especially Ohio.
Talk to us a little bit. We were speaking earlier about housing and how interest rates, in one analyst's view, is going to depress the house price gains and actually lower the transaction prices of houses. You're big not only in mortgage lending but also in auto financing, and I'm wondering whether interest rates and the prices of new and used cars are so high that market is going to begin to suffer a little bit. Are you seeing that? Are you making plans for that, or am I off base here?
No, you're exactly right, Tyler, on the home side, right? 7+% mortgage rates today, and it was 3+ at the beginning of the year. So there's a sticker shock phenomena that's occurring, and yet housing supply is very, very low. We've got just a couple of weeks in many of our markets of new homes on the market. So a very strong housing market. Unlike either coast, we don't get a lot of inflation here in the Midwest. And so we don't have the highs, but we also don't have the low lows. And so there's a stability, and certainly in many of the markets, especially here in Columbus, where I am, as we're headquartered, we've got population growth. We've got a lot of economic activity. The Intel announcement just a couple of months ago is a big deal here. Last week we had a Honda announcement of about $3.5 billion with retooling their plants and putting in battery plants with a partner. So there's a lot of growth, core growth, and growth in population, and that's going to inevitably mean housing stock increasing here and in other markets here in the Midwest.
Okay. So we're seeing American Express trade lower in part because of those loan loss reserves. We've heard some of the big banks talk about setting more reserves aside as well. And in talking about the big banks, some of the CEOs coming out in the last week or so and being a bit more cautious about the economy as we go into 2023 and the rising risk of recession. Based on what you're seeing from your vantage point, are you as cautious?
Well, the sentiment is certainly changing. The rate of increases in interest rates are causing businesses to revisit plans for 23. I think there's an inevitable impact in terms of when we talk to many of our business customers, their year-over-year pipelines, their sales activity is a bit lower, 10, 20+% lower. So that's a slowdown. But they're coming off a very strong run, and they're in great shape. And their margins may get crimped for a year or two, but they have plenty of room for that. Many of them do. There's still, after inflation, the number one issue, there's still a fundamental labor shortage. And most of these businesses that we have as customers are actually looking for employees now, and they have been for several years.
Stephen,
so we've constrained growth. That should give us a nice long-term economic run.